Your Obamacare premium is about to double. I'm not guessing here. For millions of people, this is the new reality. You're seeing that for the average person with a subsidized plan, the annual premium is expected to leap around $1,000. That's an extra $1,000 straight out of your pocket. And for many, the jump could be a lot bigger. Now, this is hitting millions of Americans right now. That's probably why you're watching this. All because the enhanced tax credits that have been lowering your cost are gone. They expired at the end of 25, leaving you to face the full force of a massive price hike. Chances are you've already gotten a letter in the mail with a new premium that made your jaw hit the floor. But what if you could legally fight back? What if there were tax strategies you could use right now to slash that bill? I'm going to show you the exact strategies that you absolutely must use to lower that new premium. Watch this before you pay a single dollar more. So what's really going on? That sticker shock you're feeling is because the enhanced subsidies from the American Rescue Plan are officially over. For the last few years, these subsidies did two huge things. They boosted the financial help people got, and they got rid of something called the subsidy cliff. And the cliff is back, and that cliff is nasty. In 2026, the old rules are in play again. And if your household income is even $1 above the 400% of the federal poverty line, you lose 100% of your premium tax credit. $1. Now, let me give you an example. For a single person in 2026, that cliff is at an income of around $63,840. So that means if you make $63,839, you could get thousands of dollars of help. But if your income is $63,841, you get nothing. Your premium could explode from a few $100 a month to over $1,000 overnight. You're stuck paying the full unsubsidized price. Now, it feels completely unfair, and honestly, it's a terrifying spot to be. You feel stuck. You're trying to earn more, but the system is punishing you for it. So now the whole game of keeping your health insurance affordable boils down to one number on your tax return, your modified adjusted gross income, and this is important. That's the number the government uses to decide if you get help. Control that number, and you control your health care costs. Fail to control it, and you will pay the price, literally. Now, as a financial planner and a CPA, I help people get through these exact kinds of financial traps. We work with retirees, small business owners, and families who are staring over this subsidy cliff and feeling completely stuck. But here's the thing, you're not powerless. The good news, your MAGI, or your modified adjusted gross income, isn't set in stone. There are powerful legal and IRS approved strategies that you can use to lower that and get back under that 400% cliff and reclaim the tax credits you deserve. So let's walk through the most effective ways you can fight this premium increase and keep your hard-earned money in your wallet. We're going to turn that frustration into a plan of action. Number one, all right, your ultimate weapon in this fight is the health savings account. This should be the very first place to look. An HSA is a special savings account for people enrolled in a high deductible health plan. And for 2026, a lot of bronze and even catastrophic plans on the marketplace are HSA eligible. So think of an HSA as a supercharged retirement account. We've covered that in other videos, but for healthcare. And it has a triple tax advantage that no other account can match. First, your contributions are tax deductible. That's the key part that lowers our MAGI. Second, the money grows tax-free. And third, when you take it out for qualified medical expenses, completely tax-free. It's the trifecta. So how does this actually lower your insurance bill? Well, every dollar you put into an HSA is an above-the-line deduction. That means it reduces your modified adjusted gross income dollar for dollar. So for 26, the contribution limits are pretty generous. With self-only coverage, you can put in up to $4,400. With family coverage, $8,750. And if you're age 55 or older, you can throw in another $1,000 as a catch-up contribution. So let's take a real-world example here. Say you're a couple, both 55 or older, and your projected modified adjusted gross income is $90,000. Under the 26 rules, the subsidy cliff for a two-person household is around $86,560. You're over the cliff and staring down the barrel of a full-size premium. We're talking maybe $1,500 a month or even more. But you have a family HSA eligible plan. So you decide to max it out. You can contribute $87.50 for the family limit. And since you're both over 55, you can add your $1,000 contribution. That's a total contribution of $10,750. And just like that, your modified adjusted gross income dropped from $90,000 all the way down to $79,250. You just leaped from being thousands over the cliff to being more than $7,000 safely under it. You literally just went from getting zero help to qualifying for thousands of dollars in premium tax credits, all while funding a powerful tax-free account for your future. You get to keep the money. And this is the number one strategy for a reason. Now, number two is the power of pre-tax retirement accounts. Strategy two is to get aggressive with your pre-tax retirement accounts. The logic is simple. You're just pushing that income into the future. Instead of taking the money today where it counts against you for subsidies, you're putting it into a tax-deferred account and promising to pay taxes on it later in retirement. Now, I know we've talked a lot about Roths, and there's a place for that, but if we're trying to combat Obamacare expenses, the Roth is not going to work. It has to be pre-tax contributions. Think your traditional IRA, pre-tax 401k, Roth IRA, Roth 401k, not going to work as I already said. So let's look at those 26 limits. For a traditional IRA, you can contribute up to $7,500. If you're 50 or older, you can go up to $8,600. Now, if you have a 401k, the numbers are even bigger. An employee contribution limit for 26 is $24,500, and then you have a catch-up for another $8,000. And there's even a super catch-up for those who are 60 to 63, allowing us to add $11,250 on top of that. So let's try another example here. So let's picture a 62-year-old who retired early. Her income from part-time consulting and retirement account withdrawals is $70,000. As a single person, she's well over that $63,840 subsidy cliff and facing a monster insurance bill. Now let's just say she contributes $20,000 to her 401k. We all know she could do more, but let's just say she did that. Her new modified adjusted gross income is $50,000. She went from being completely unsubsidized to sitting at the 300% level, 314% of the federal poverty level. This one move could slash her premiums from $1,200 a month down to around $400, and that's a savings of nearly $10,000 a year. Using the 401ks and the IRAs can really, really help you. And if you didn't get it done, the nice thing about the IRA is you can contribute to it all the way up until you file your tax return next year, as long as you do it by April 15th. So if you mess this up, remember in the back of your head, that still could help you next year. Now, number three, what about those who are self-employed? Okay, if you're self-employed, freelance, gig worker, small business owner, you have superpowers too. First, you can use more powerful retirement accounts like the SEP or the 401k like we just talked about. And you can contribute way more than a standard IRA, often up to 20 to 25% of your net self-employment income, which can really drop that modified adjusted gross income. But secondly, you can deduct every single legitimate business expense. Every dollar you spend on your business, your home office, mileage, software, new computers, maybe it's time to upgrade that truck, supplies. You can lower that net income, which directly lowers your modified adjusted gross income. And that way we don't have to leave a single dollar on the table. You control the timing. So if you're getting close to that cliff at the end of the year, you can play it smart and go out and spend some money at the end of the year. Now, don't just waste money, all right? That's not what we're talking about here. But smart planning, and if we needed that new truck or we needed a new trailer or we need a new saw or whatever it is, new computer, because we're dealing with a cliff, sometimes a little bit can make a massive, massive difference. And you're in control of that modified adjusted gross income. Now, I've seen this happen back before the cliff went away. We did this quite often. It literally can save people as much as $20,000 I've seen just within my own client base. So look, I know this can feel like trying to solve a puzzle with the lights off. Juggling your income, the poverty levels, all these contribution limits. If it feels overwhelming, just know that helping people build a clear, actionable plan for these situations is what we do. There's a link in the description where you can schedule a consultation and get personalized advice. While tax strategies are the heavy hitters, don't forget the final piece of the puzzle, the plan you actually choose. This isn't about lowering your modified adjusted gross income, but also about controlling your total out-of-pocket costs. A lot of people just default to a silver plan since that's what the subsidies are based on, but you have to do the math. You might find that a bronze plan dramatically lowers your monthly premium. Yeah, you may trade off some higher deductibles, but if you're pretty healthy, the monthly savings could be well worth it. On the flip side, don't ignore the gold plan. Sometimes after subsidies, that gold plan may not be that expensive. It may be close to a silver. So make sure you're working with a good insurance guy to help you out with that. Don't try to do this on your own. Get some advice. A gold plan could save you thousands in out-of-pocket costs, but the key is to use the comparison tools in the marketplace and look at the total estimated annual cost, not just the premium. So let's be real. These 26 premium hikes are a gut punch. Seeing your health insurance bill double or even triple, incredibly stressful. But I hope you see now that you're not powerless. You have a set of legal, effective tools that you can use to fight back. And by focusing on that one critical number, your modified adjusted gross income, you can make it your friend. You can take back control. So your action plan is simple. First, max out that HSA. If you need more, max out that pre-tax retirement. Make sure we get that straight. It's got to be a pre-tax retirement account. And third, if you're self-employed, deduct everything and use that advanced retirement plans available to you. And if we're still short, maybe this is the right year to buy a piece of equipment. Premium increases are a blunt instrument, but your response can be surgical. By strategically managing your income, you can step back from the subsidy cliff, reclaim your tax credits, and turn a massive bill into a manageable one. So if this video gave you some clarity on a plan, do me a favor, hit that subscribe button, and please share it with a friend or family member who got that same shocking letter in the mail. They need to see this video.